Meta shares are higher this morning after a report said the company is planning to meaningfully cut the resources devoted to its Metaverse efforts, slashing budgets there by as much as 30% next year. Let's bring in Gil Luria, D.A. Davidson's head of technology research, for his take on this. So, Gil, how do you think about it in terms of magnitude of spending? The market's, added about $100 billion in market cap to Meta this morning in response.
Yeah, if they shut down the Reality Labs business, earnings would go up by about 25%. They lost $18 billion last year. And let's not forget, the business is there for a reason. Mark Zuckerberg wants to own the next platform. The next hardware platform, in his eyes, will be a combination of glasses and goggles, not a handset. And he doesn't want that to be owned by Apple and Google anymore, because he has to pay them 30% off the top. That's why he's been investing so much over the years in Reality Labs. But what's happened is he's realized that AI is much further down the road than the shift to the hardware platform. So he would rather invest in winning in AI and building data centers to support his research and better frontier models and better chat than invest in the hardware platform, which may take longer to play out. That doesn't mean we're not going to get better Ray-Ban glasses and Oakleys and the display glasses. It just means that he needs to shift some of those resources to AI, because AI is incredibly competitive with Google, with OpenAI, with Anthropic, and to some extent with Amazon, Microsoft, and many Chinese players. So that's what he's doing. He's moving chips from Reality Labs to the AI investment.
That would imply, though, that he's not going to let all the money fall to the bottom line that they're not spending on Metaverse, right? I mean, I know we don't know granular details here, but it would suggest that, essentially padding out the AI investment budget.
Well, that's right. That's why investors were disappointed when they reported the quarter. They reported 25% top-line growth in the quarter, which, by the way, is almost twice as much as Google. It's faster than Microsoft, Apple, and Amazon. And the stock was down because they commented about increasing CapEx and operating expenses even faster than that next year, meaning lower margins and not as much earnings growth. So investors reacted badly to that. And as he's done in the past, he's realized that in order to keep the share price going up, he needs to moderate that. So he needs to move some resources from Reality Labs to AI so he can maintain margins into next year and can continue to grow earnings at the rate of revenue growth, which again is a very healthy revenue growth.